All right, guys. Oh, sorry. Let me get this thing going. I know it's recording. I do apologize for my lateness. All right, guys. I'm sorry. I'm setting up. I apologize for my lateness. I'll give people a second to log in. So welcome, welcome, welcome. I had one of those senior moments. Moving a little slow today, but been busy because of the holidays, or incoming holidays. So I like that. Let's go. Money making time. Yes. Interesting story. My daughter told me her friends who watch my Zoom call me Money Mike. So I got a new nickname, Money Mike. I'm not sure if I like it or not, but it is what it is. So I'll give you guys a few minutes to log in. I am actually going to go into the market's close, waiting for it to. I'm trying to get into my CNBC. But as usual, technology doesn't want to work with me right now. Unbelievable. So bear with me a second, and then we'll get started. Where's my, there it is. Okay. Let's see what's going on the close. All right. So first and foremost, I got a couple of you guys here, so I'll wait a few minutes, but chit chat. It's been an interesting year, been an interesting week. What I'm going to do today is I'm going to talk about some of the IPOs that have come public this year. One of the things that's come up is I've gotten a number of emails over this past week, 2 weeks, concerning some of the deals that have come, and I don't want to say challenging me. That's not the correct word. And I'm just saying inquisitive minds are saying, why wait till the stock goes to a high? Why not, if you know it's a great company, why not just buy it now? Fact of the matter is, neither you nor I know if it's a great company right now. The company goes public, we don't know if it's a great company or not. We look at it, we follow it, but you don't really know if it's a great company. Now, in a couple of previous Wall Street Wednesdays. And by the way, welcome to Wall Street Wednesday. I forgot. Welcome to Wall Street Wednesday. Today is December 23rd, 2 days before Christmas. So this is episode 28. I believe. I could be wrong. I'll have to check my numbers. All right. So what I was saying is that I got a number of emails saying, Professor, the stocks, why wait? It's a great company. I know it's a great company. Why wait? I want to buy it now. I've been doing this for a while, been experiencing this for a while. When I say a while, 30 years. Yeah, 30 years at least. And I'm here to tell you, you want to be patient, you want to wait. I have posted some diagrams, pictures that I'm going to use today. And hopefully we can go through this and explain it. So let me just jump on a couple of these right now. Hold on a second. So what I have here, what's up, Twin? Twin, you'll appreciate this. What I have here is some data that was compiled, and let me type in the guys. Come on, why won't you let me type in? All right, some of you guys will have to help me with it. Let me type in, I'll tell you what the guy's name is. The guy's name is Ritter, Ritter. Again, Ritter. If you go to Ritter and then type in IPO, Dr. Ritter is a professor at University of Florida. Twin, I never had him in class. I don't think you had him. I think he was gone by the time, we were gone by the time he got there. But he's considered one of the authorities on IPO stocks. I pulled the picture you're looking at now, I pulled it off of Dr. Ritter's site. I advise you, if you really have an interest in IPO stock and want to trade it, and you're trying to understand how they work and how they go, I thank you, by the way. I highly recommend you pull down his data. I've gone to his data for the past several years. As I told you guys, I'm working on a book about IPOs and the IPO strategy. And a lot of my information comes from Dr. Ritter. So I highly advise you to go to the site and check it out. So anyway, what Dr. Ritter has here is, I just cut the list for 2020. So these are IPOs that were priced and doubled the first day. All right. So I pulled this up for a reason. Now, I'm gonna switch back to my screen because I can barely read it. I know you guys can. I'll leave it up there. Well, I'll leave it up there. So let me say a couple things. One and foremost, an hot IPO is hot because when they actually build the book, building a book is when the investment bankers speak to the institutional clients and they tell them how much stock they want to buy and at what price they want to pay for it. That's building a book. And hot IPO will have a book that is anywhere from 2 to 3 times or more oversubscribed. What that means, and what I mean by oversubscribed, is if they're doing an offering, an IPO offering for 10 million shares, they have orders for 20 million shares. That's 2 times. It's 2 times oversubscribed. If it's for 30,000 shares, it's 3 times oversubscribed. So the hotter the deal, the more you're going to see the deal oversubscribed. That's one of the reasons why I've always said to you guys, for us, individuals who are non-institutional investors, the odds of us getting a hot IPO stock of slim and none. And as the saying goes, slim just left town. That's the reason why I developed this strategy. I was not able to get hot IPO stocks, but these hot IPO stocks can turn into be really, really great companies. I mentioned this last week. I'll mention it again. The FANGs. The FANG, again, depending on who you talk to, but the FANGs are Facebook, Amazon, Apple, Netflix, who am I missing? Google, and Microsoft. So you'll see some combination of those. Now, the reason why I bring it up is every one of those companies was an IPO stock. Every one of them. Every one of them gave you a chance to buy that stock early on as they were making their moves. Now, the reason why I bring this up again is, and I highly recommend it, I'm gonna put something together for that maybe over the break. But again, my pricing model, PRCSMM. Price stands for product, services, the P I should say, product and services. The R stands for reward to risk. The C stands for capital. The S stands for scalable. The M stands for management. The second M stands for market. Every one of these companies that we just talked about, the FANG, had all those going for them. All right? Those are the 6 criteria I look at. So, one of the things I want to talk about, I'm going to jump to this one now. I'm jumping to Lemonade. Lemonade is on this list. Lemonade was, and I wrote down the numbers to make sure I get it right. Lemonade was priced at $29 on July 2nd. Opened up and traded the first day as high as $69. Within 2 or 3 days later, 2 days later, stock traded as high as $99 a share. Now the chart you're looking at will show you that not only did Lemonade hit that number the second day of trading, the third day of trading, it took them 3 months to get back to that. This is the reason why I tell you guys, if you're going to play this, if you're going to trade IPOs, I highly recommend that you have the patience and wait. As you can see, that first day run up, the demand was there. It was a hot IPO. All right? This is what I'm trying to help you avoid. Get caught up in that frenzy, and if you brought that hot IPO Lemonade the first or second day, you had to wait 3 months for that thing to get back to the highs it had hit the first 2 days of trading. 3 months. All right? Now, once the stock did get back to that high, you can't see it now, but basically because I'm blocking it, so let me see if I can. No, didn't work. But you can see right in here the congestion right in the middle of the chart. And then this thing broke out. It broke through that 99 and ran. And I'm not sure where it's at today. But I'm going to pull it up right now over here and see. And Lemonade right now, today it closed at 133. So virtually from the breakout, when it finally did get through that old high, that set the first and second day, it ran from $100 to $133. All right, that's a 33% move, and basically a short period of time, less than 30 days. Not bad. The key to this is always about patience. It's the strategy. It's about patience. Now, let me go back to my list real quick. And some of these names you're familiar with. And here's what's interesting. Several of these stocks did not break above their opening week high. Several of these stocks, repeat, did not break above their opening opening 2-day high. Now these were hot IPOs and they did not. Several of these stocks are not, repeat, not back to their opening highs. In fact, they've traded sideways or traded down. They're still above their syndicate price where the offering was, but they're substantially lower than where the price of the stock, where the stock opened up and as high as it traded the first 2 days. Several of these stocks look horrible. From the day they came public, they haven't gone any higher. So I tell you all this to tell you a couple things. One, you got to do your homework on these companies. All right, run them through the price them criteria, my price them. Do some research on them. Just because they open up and go high does not mean they're going to stay higher. All right, that's the key to this. This is the reason why I have patience. As I mentioned to you, let me get out of this. As I mentioned to you, one of the stocks I mentioned to you was Seer, S-E-E-R. Seer was a hot IPO. Seer has been as high as $86 a share. Today the stock closed down at $63, up a couple of pennies today, up some change. As I mentioned last week, I was watching Seer. It had done some really bullish things in terms of the VCs and private equity guys buying more stock at the offering price during the IPO. And after the stock stopped its run the first 2 or 3 days, the stock has done nothing but go straight down. So why am I telling you this? Easy. I'm watching the company. I'm following the company. I'm looking at the company. But for me, let's see, 1, 2, 3, 4, 5, 6 days going high and setting new highs. 6 days in a row. And then finally, last week, reached a high 85, closed at 76 and change, and then went from there down as low as $57, $56. So, patience, patience, patience. Now, again, I'm not here to beat you guys up. I'm just here to help you understand this. If you look at the chart, and I'm going to now, if you look at the chart on Dash, DSSH, I didn't put it up this time. Again, Dash opened up first day, went as high as 195 and change, and hasn't seen it since. I had told you that the opening day low was 163. I told you I felt it would test that 163 number. It tested 163, and then from there went down as low as 150 and change. If you like Dash and you want to invest in Dash, my comment is to use this. Do not try and bottom fish. Wait for the stock to work its way back up and through this. Remember, and I had this conversation with some other traders, and I know you guys have heard this comment. And the comment is, I'm just going to wait for it to get back to what I paid for it, then I'm going to get out of it. The problem you have with that is that sometimes they never get back. How long is it going to take to get back? I've shown you some stocks that have taken 3, 4, 5 months. Lemonade took 3 months. There's several of these hot IPOs that came out this year that it took them 3, 4 months to get back to the opening high, if they even got back. So that's the patience that we wait for. Again, that's Dash. Now, the other one I mentioned to you guys, and I'll pull it up again, is Wish, which is, God, I forgot the name that quick. Hold on a second. Let me get the name again. Context Logic. You know, I am with names. I'm better with symbols than I am names. Stock was priced at 24, opened up, went down. It broke through 24 intraday, the third day of trading, and then it broke down again. This is a short. I would stay short the stock. If you're not short, I would get short the stock. The only challenge you have with shorting stock, and make sure you take note of this, in order to short stock, you need to be able to borrow shares. The investment banker in this Goldman Sachs, what they're going to do now is they're going to drag their feet on delivering those shares out to the brokerage firms, out to the clients that, for delivery. They're going to drag their feet. And the reason why they're going to drag their feet is you cannot short a stock unless you can borrow the stock. You cannot borrow stock if Wall Street does not have the stock to loan out. That's the reason why Goldman will drag their feet. On a daily basis, in fact, I'm doing it right now, I check to see if Wish has any options yet. And I'm pulling it up now, and I'm just double checking because I hadn't checked today. Of course, it's taking its sweet time. And let me just double check. Does Wish have any, come on, work with me here. Does Wish have any options? And the answer is Wish has options now. Bingo. All righty. Now, the reason why I bring up this, you don't have to short the stock now. You can actually buy puts. So again, you don't have to short the stock now. You can buy puts. I would say to you, if you're going to buy puts, two things. One, buy slightly out of the money or out of the money, and buy time. Give this thing time to work in your favor. Now, I haven't looked at the premiums. In fact, I should have looked at the premiums and see how rich it is. Oh, come on. I apologize. I hit the wrong button, so I went to the wrong place. Let's see. Wish. Content logic, option chains. So let's see. You're looking at a $21 stock. These options expire in 23 days. And the calls are $2.60. The puts are, the buy the puts is $1.40. That means on $1.40 put, if you buy it, your break even is going to be, what is that, $18.60? $18.60 is your break even. Anything below that's going to be your pure profit. Those are 23 days. That's actually good enough time. But if you want to go longer, 58 days, those 20 puts would cost you $3.20. I'd go for the 17.5. Maybe I wouldn't. I'm looking at the premium on that. But again, for those who understand options, I'm looking at it. The other thing about it, for those who understand what I did before when I talked about a synthetic hedge, putting on a synthetic hedge on Wish is not a bad idea. What I would do if I was doing a synthetic hedge on Wish is, bear with me, I'll explain what I mean by short. What I would do is to play this to the downside, which means shorting. Shorting means you're playing for the stock price to go down. You make money when the stock price falls. You lose money when the stock price goes up. That's shorting. If you own a stock that you expect to go up higher in price, that means that you're long. So long means you buy the stock at a low price, expect to sell it at a higher price. Shorting means you sell it at a high price and expect to buy it at a low price. I expect Wish to go down further. So that's the reason why I said I would short Wish. The synthetic hedge synthetic, if you're going to do a hedge synthetic on this, it's easy. Buy a at the money put, sell a at the money call. Then buy just out of the money call as your hedge. And that out of the money call should be at a strike price higher than the call price where it is on your synthetic. So your synthetic again is long the put, short a call at the current stock price or right around it. So I would do $20. I'd buy a $20 put, short a $20 call. And to hedge this, I would buy a 22.5 call. I'm looking at it right now. Doing this will do a couple things. It'll lower your costs, and it'll allow you to buy more time because you'll have a lower cost factor. That's how I would play this. And as I'm looking at it now, I just found out to have options. I will look at this today, tomorrow, and don't be surprised if you hear me say that I am short Wish. I had told you I was looking to short it. I was waiting for the stock to be available, stock loan, but I don't have to wait for stock loan anymore. I can actually buy the puts. Again, when an IPO, understand this, and you guys, we understand this. All the talk, all the hype, all the expectations on what to expect on the stock, like Content Logic, is already out in the public. They've done the roadshow. They've traveled around the country. They spoke to institutional investors. They pounded the table and told them how great their company was. They told them how great it was, why they should own it, and they priced it, and it opened up and didn't even hold that price. That is a deal that is in trouble. Play it to the short side. I don't see much upside potential. You can actually check on it, but there's not much upside potential. And again, if it even gets near 24 again, you're going to have some problems. So I would play it to the short side. If you actually short the stock, do a buy loss. Do a buy loss. Not a stop loss, a buy loss. In other words, you want to make sure that you can cover that position. And again, if you're shorting here at 21 and change, I'd use a 10% stop, a buy stop, 10% above where you shorted. And there's no question, for those who have a little more, what's the word I want to say, can take a little more risk, then I would use a buy stop at 24 and change. Move above 24, 24.10, 24.20. Again, that means it's actually penetrated the syndicate price of 24, the IPO price, and has a chance of maybe running. I don't think so, but that's what I would do. All right. Now, I got to say this. I just got to say this. I'm not bragging, but I got to say this. The IPO strategy will put money in your pocket. I'm telling you. Now, if you're the type of person that you need to see you need to trade every day, and you're itching, then this strategy is not going to give you a buy signal every day. It's not. But when it finally does give me a buy signal or a short signal, but especially on the buy side, these things can run really fast, as you've seen. Now, last week I also mentioned Upstart. Upstart was interesting, and the company's name is Upstart. Symbol is UPST. UPST. So, I told you that last week. I was watching Upstart, and I also told you that I was watching, that's how I did it. I got it. Last week I told you I was watching Upstart, Sear, C3, and a couple others. I can't remember. Well, here's the deal with Upstart. Very interesting stock. Upstart had 4 days in a row of just going up. Higher, higher, higher. The third day of trading, it traded as high as $48, above $48 a share, close to 49, 48 and change. Then what happened is the next day, it tried to get through the previous day's high, but it didn't. It failed to pull back. The next day, it pulled back. Today, it went through its first 3 days of trading high. It went through. I did not buy it. I'd love to tell you that my wisdom and all this told me not to buy it. What honestly happened was I watched it open this morning. I watched it close yesterday. I thought it was going to take out the old high of 48 and change today, which it did. What I didn't like about it was I just didn't see the follow through. And as you can, maybe you can't see, it ended up going as high as $51 and change, and then pulled back to close at $46.32, which was below the previous highs. So the only reason why I did not buy the stock, by the time I looked at it again this morning and ran through, I looked at it. I typically try not to buy the first half hour to hour of the day. For those who've been around the market, we call that amateur hour. So I typically wait. And if you ever watch the market, for those who watch, the first hour and last half hour, typically are the most volatile times of the market on average. The first hour and the last half hour. That's when you're going to see most of your volatility. So with that, I waited for after the first hour for trading, and that's when it started to pull back. So I'm not seeing the follow through I want to see. It's not holding up. And once that opening hype came back, it pulled back. So make a long story short, I did not buy the stock. And now I'm sitting here saying I'm glad I didn't. My strategy works really well, but like all strategies, it's not 100%. But when you nail one, it's a beautiful, beautiful thing. All right. Other than that, I don't have much. I'm not really doing much now. I don't think. Just so you guys know, the IPO calendar, it's interesting. Usually right around now, the IPO calendar dries up. You don't see many IPOs, and you don't see much going on over in you don't see much going on until probably the second or third week of January, historically. But here's what's going on. It's interesting times now. One, we're seeing so many international stocks doing IPOs. It's crazy. So some of these stocks some of these countries might be bringing IPOs to the markets during this time period. It's going to be interesting. China's one of them. The other thing that I found interesting was, we talked about this. The other thing I found interesting was the number of SPACs coming to market. So right now you're seeing these blank check companies coming to market like crazy. Earlier this week there was 10 in one day. I'm not sure what investors are looking at. I just don't see it. It doesn't register with me. I'd love it if you guys want to give me a blank check. So maybe I should start a fund, basically start a blank check company and just have you guys everyone send me a blank check and just send me cash, and then I'll figure out what I'm gonna do with it after I get it. Really, I just have no understanding on that. The other thing I was gonna say to you guys before I forget too is, rehash before I forget. One, you're gonna see less IPOs. So take a break. You can look for breakouts. Your breakouts on these IPOs are going to be on lower volume, typically. Again, I know a number of you right now work on Wall Street. You guys know what I'm talking about. This is the time when senior management, especially those who are making a lot of decisions, have left, and they'll tell you they won't be back till the second week of January. They're on vacation. They're slowing things down. They're wrapping up. So don't expect a lot of activity. Do expect to see moves off a light volume. So just be careful with that. All right. So I went over a couple things. I'm excited. I'm excited. As I had told you a week or 2 weeks ago, I'm working on a project that I should have done by the second week of January. I'm excited about it. I don't want to talk about it too much right now, but I am excited about it. When I bring it up and get it going, it's going to be a beautiful thing, and I will share all of it with you. But it's pretty compelling. I'm excited about it. And, I get I haven't been this excited about investing and what I'm doing in a long time. So I'll explain to you what's going on. I'm pretty excited about it, and I think that you guys will benefit from it. All right. It's going to be a short one today. Any questions? I'm just looking through to see if there's any questions. I answered the question on shorting. Most of you guys are just waving at me. Let's see. What is this? Not sure if I want to talk about AI. It ran to 183 after I got in at 133, pulled back to 160. Can you discuss exit strategies and targets with IPO strategy? Great. All right. Sure. The hardest part of the IPO strategy is trying to figure out when to get out. It's the hardest part. So typically what I do is this. As you guys know, I talk to you all the time about putting stops. So first and foremost, raise your stop from wherever it was to right where you purchased at 133. So raise it to 133. I think my cost was 135. So you got a better price than me. How is it that you got a better price than me and I'm the one actually putting out these recommendations? What's going on here? Jeez, man, I gotta figure something out. Anyway, I'm only kidding. Anyway, once the stock is above a 50% move on me, I'll move my stop up to about a 20 or 30% gain. The other thing I'll do too is that once the stock starts to run, I'm going to say a couple of things here, and anyone that's ever traded for a living is going to understand what I'm about to say. If I've had a string of losers, and or if I need money to pay the mortgage, I'm taking profits. You can never go wrong printing black ink. If you took profits at 183, or even take it here at 160, let me just see, 160, I'm looking at the wrong stock. 161, if you take it here, 161, you're printing black ink. That's a good thing. Now, for me, how can I put this? I look into the company, and if I think there's more in it, in other words, I'm not really quick to jump out of line. I'm really not quick to jump out of line. The reason for the pause is I'm thinking this through for you. So if you're new to this, if you haven't been printing any what I call black ink, you haven't been making money, you can't go wrong taking profits. At 183, 160, take your profit, close it, and go about your business. The one thing I'm going to tell you is if you do take your profit, don't look back. Don't look back and say, man, I should have held this because now it's back at 183. Don't look back and say, man, I'm glad I sold it at 160 because now it's 130. Don't even look back. Don't torture yourself. All right. For me, and I'll give you a prime example, Unity. 1 second, let me pull it up. Unity's all-time high is 174. I believe it went through it today. Yep, it said it today. And the stock closed at 169. I own Unity somewhere, I got to go look at my cost, but somewhere in the high 80s or low 90s. And the only thing I can say is that I've owned the stock for a minute, and had I taken that first profit or when it pulled back that first time, I wouldn't have seen where it is now. I wouldn't be in the stock to this point. So I guess what I'm saying to you is if you can afford to do more, to hold it longer, great. If you want to take a profit, take a profit. Now, you brought up a good point, and I'm going to bring this up. And this is one of the things I was talking about with some other traders on the phone. I know I got a couple of traders here who work on desk. I'm about to say something that might make sense to you guys, it might not. When I was running the hedge fund, I did not look at how much I was investing. All right. I know I told you guys this before. I'm going to say it again. I thought in terms of 1,000 share blocks, 2,000 share blocks, 10,000 share blocks. So if I was buying a stock, whether it be a $10 stock or a $100 stock or a $200 stock, I was going to take down a block of at least 1,000 shares. The way my mind worked as a trader was when I took down my 1,000 shares, if I was looking for 5, 10, whatever points I was looking for, if I made 5 points, I made $5,000. Real easy math for me. If I made 10 points, that was $10,000. All right. If I took down a bigger position, but I always thought in terms of blocks and movement. I never thought in terms of price and movement. Is that making sense? I was the kind of guy that if I was trading, now I never had to trade a $2,000 stock, but if I was trading a $2,000 stock, I was going to take down a block of 1,000 shares. I wasn't looking at how much money I was putting into the marketplace. I was only looking at the shares. And when I looked at the shares, follow me now, if I thought the stock could pull back 2 points, then I'm going, okay, if I'm wrong, I'll lose $20,000. If I'm right, my upside, I think, is 10 points, I'll make 100,000. That's how math worked in my head. Now, the reason why I say this to you guys is the reason why I did it that way was I really never wanted to look at how much money I was investing. I never wanted to get that nervous. I just thought in terms of blocks. It took the pressure off me in terms of like, I got $1 million in the market. I got $5 million in the market. I got $10,000 in the market. And then all of a sudden, wow, I got $10,000 in the market. I got whatever that number is for you, it's going to make you nervous. And when I started as a trader, even for me to think about having $5,000 in one position in the market, it frightened me so much that I don't know if I'd ever made it through as a trader. So I had to start thinking other ways. I had to remove those emotions. I also had to remove that fear of how much money was in the marketplace. All right, so I don't think, to this day, I still don't think in terms of dollar amounts. I just think in terms of blocks. Shame of the matter is I'm not able to buy those 10, 20, 30,000 share blocks anymore, but that's okay. So if you think in terms of blocks, again, if you think in terms of blocks, it'll help you. If it's 100 shares, if your block is 100 or 10 shares, then work with whatever you have. But don't get caught up in the numbers. Now, you're asking me, what do I do to research on the companies? I do my own research. I really do. Now, again, I'm not trying to make you guys junior analysts. I'm not trying to make you the analyst that's going to get a job on Wall Street and put a recommendation out there. All I'm saying to you is, when I say do research on the company, know what the product is, know what their market is, know what their industry is. Again, I'm not going through the numbers on C3 AI, But let me just back up for a minute. AI. Is there any other sector, technology sector right now that's hotter than, has more upside potential than AI? All right. That's where we're going to. For those who don't understand, and again, I'm not trying to preach here, but artificial intelligence is all based upon how much video the equipment, how much video data this piece of equipment that's using artificial intelligence can take in. The way artificial intelligence works is it analyzes video. That's the reason why for the last 2 years you saw the big push towards 5G. They had to get something that could handle more data and faster because AI, artificial intelligence, needs it. Now that we have it, AI is going to explode. Whether we're in the right company or not, I can't answer that. I can tell you though that that sector of the market is probably going to look at some double-digit growth. I wouldn't be surprised to see for the industry a 20% growth, if not higher. Which leads me back to that's the reason why I looked at C3 and Upstart. I'm looking at them. I'm going right now. You guys are pure plays in artificial intelligence. It's a segment of the market that's about to explode. It's moving that direction. As you guys know, as you watch, everyone's talking about it now. Who is it? Apple's now talking about building autonomous cars that link up to their phones, with their other equipment. We're hearing news about Tesla. We're hearing news about the electric car manufacturers out at China. When you start putting artificial intelligence into these cars, it means that they need to stream that data back and forth. When you're on the internet in a car, that data is streaming. And when it's sending data about the car, it's not sending text data, it's sending video. So that's one of the things that you guys got to look at. I hate that. I'm not trying to put pressure on you. I'm just trying to let you guys know that you got to do your research. You just got to look and read. Once you look and read, and let me explain it this way. When you look at the financials and you look and read, there's no way of really telling what price the stock's going to trade at. All right. These institutional investors will come through, they'll do some forecasting, they'll put some numbers on it and what they expect, but even they are guessing. This is the reason why, and I know my students are on here. You've heard me say this before. We can do all the valuation in the world. Valuation on a company is nothing more than an educated guess. And as you guys know how many times these models are just wrong. The stock is growing and companies growing faster, moving faster than what the model can represent. And part of that problem is because we have a problem putting in the model a 20% growth rate on revenue, a 30 or 40% growth rate on revenue. You just look and say, there's no way this company can do that. So all I have to say is throw the valuations out the window. A stock is worth what someone's willing to pay you for it. It's just that simple. All right? If someone's willing to pay you more than what you paid for it, it means it's going up in price. The other thing I'm going to say, and I try to explain this, and I'll be brief, and that is you got to start looking at industries and sectors that you think will outperform the economy, outperform the market. Again, I'm not trying to be funny. Fair assumption. Is Google outperforming the market? Answer is yeah. Is Tesla outperforming the market? Is Apple outperforming the market? So it's not hard to outperform the market when you actually look and say what stocks are outperforming the market. So with all I've said, I'm not a big fan of valuation. And as you guys have seen, there's a number of companies out there that are trading way higher than what the valuation ever put on the company was. All right. I guess I'm excited, so I guess I'm going to do it. I'm in the process right now. This is my good news. So I'm in the process right now. I'm working with a couple of people on this. But I'm in the process right now of putting together what I call my IPO strategy alerts. And literally what it's going to do is I'm going to send out alerts through text messaging. I'm sending out alerts basically anytime I'm buying or selling a security. I'm just going to put, IPOs. Anytime I see an IPO that I think's a buyer, I'm just going to alert and send out the alert. Earlier this week, I sent out a buy on Airbnb. I didn't buy it. The reason why I didn't buy it is, and I explained this before, but I'll say it again, I'm not sure how much upside I can get in Airbnb. And what I meant by that is stock was trading, as you guys know, up in the 150s, 160s. Let me see where it's at now. 150s, 160s. It went through its first day, sorry, I'm stuttering. So 1, 2, 3 days in a row, stock went to, oh, come on. I'm sorry, I'm waiting for my chart. System's running slow. I wonder why my system's running so slow. Oh, all right. So first day it went to 164, 165, pulled back from there. And it was at 1, 2, 3, 4, 5, 6, 7 days later, it went through that 165, went to 168. The next day went as high as 175, and now it's back down to that below the first day high. I didn't think there was much in Airbnb. It's not technology. There's a pandemic, so I'm not sure how much is in there. I'm not sure what kind of numbers they're forecasting going forward. So I just didn't think there would be much push in this after it went through that high. And that's the reason why I put it out there, but I had no interest in it. So those, and make sure you understand what I'm about to say. No question, if my count size was large and I could have got 1,000 shares, I'd have took this as a quick day trade. I'd have picked up 1,000 shares, brought it when it went through, watched the momentum, and then probably took a little profit and moved about my business. I talk about that a lot now, that the younger me would have traded this, no question. When it went through that 165 number, I'd have traded and got it 2 or 3 points and been happy with it. The older me is not as active. In other words, I'm not looking to trade every day, and I'm not looking to sit in front of the machine all day and make these trades. It takes a lot of energy and a lot of time. So I tend to be more of a patient investor now. I guess it's the age, and I call it the wisdom that comes with that. All right, let me see. Any other questions? Any other questions? I'm going to bring up something. One of my former students told me this, and it was pretty interesting. And I'll mention it again. And I talked to some other people about this. And that is, he got involved in snow. And he brought it, in the recommendation, he brought it. And when snow got up to the 434 number, he felt like snow was overextended. So what he did was, he actually wrote calls against his snow position. Now, for you guys who are non-option traders, you're not going to understand what I'm talking about. For those who are option traders, you understand that what he did was he collected the premium by writing those calls. He wrote it. He said, I was okay if they'd have called the stock from me at 435. I was okay if they called away from it. He said, because I had a tremendous profit in it. He said, so what I did was I wrote calls. I collected the premium. When the stock came in, the calls were, value dropped. I brought back the calls. I sold the stock, and I made some additional money. How can I put this? There are 1,000 ways to make money in the market. All right. He took my strategy and he expanded upon it, which is what you should do. I take my own strategy and expand upon it. So whatever strategy is working for you, take it and expand upon it. There's always ways to make more money on it. One of the things I had talked to him about when he said that to me, I said, well, what I would have done is, I said, I'm not saying it's right or wrong. I said, this is just another way of doing it. I said, I would have actually taken and brought an at-the-money put. I said to him now, before I even go any further, I said, I'm going to look and see how much premium they were charging, but I would buy an at-the-money put. And when I brought that at-the-money put, I said, if the stock pulled back, I locked in profit because that put's going to go up in value. If the stock continued to go higher, that put would become worthless, but that's okay because I'm trading on house money. You'll hear me talk about this a lot. This is house money. It's not my money. My money is the principal. My principal. And my job as a trader and investor is 2 things. 1, make money. 2, not lose my principal. All right, that's my job. I was talking to some young investors about this. That's your job. And so by marrying that with a put, using house money, if the stock started to pull back down, that put was going to go up in value. That's why you had that put. By putting a put with that, you lock in profit. Understand that. By buying that put and put at the strike price where the stock currently is, you're locking in profit. If the stock goes down, your put's going up in value, you locked in profit. If the stock goes up, your put's going to go down in value. But if the stock continues going, you're okay with that because it's going higher and you're going to eventually make more than your premium that you paid for the put, and it's going to go higher. That's how I trade volatile. When I see volatile situations I think are going to go higher in my favor, that's what I do. All right. I threw a lot of stuff at you guys. I'm not sure. I don't have anything else. So I threw a lot of stuff at you guys. If you have any questions, go ahead and ask. As I'm looking for questions, I just want to say again, season's greetings. Happy New Year. Have a blessed one, guys. Remember that the reason why I do this is so you can put money in your pocket. What about collecting premiums and doing a bull put spread? That's exactly what I'm recommending in my synthetic hedge. I'm recommending a bull put spread and then taking that premium and buying a call. That's what I'm doing. All right. Oh, thank you, Twin. So hopefully you understand. We're talking about whoever's, I'm sorry. I believe this is Alex. Thank you, Ham. So that's what I was talking about. Thank you, Christian. Merry Christmas to all you guys. Happy New Year. Hopefully you made some extra money so you can go out there and spend it on the family and really, really have a good time. All right, I'm about to sign off. I do appreciate you guys. Let's see, next week, I'll see you next week before the new year, just touching base. And I'm not sure if I'll be doing anything. I mean, I'll be watching the market, but I'm not sure what's going to happen. We'll just be patient. All right, have a blessed one. I will talk to you guys later. Thank you so much.